Hi, this is Nader Hamid, Portfolio Manager with TWM Group at Hollis Wealth. Needless to say, it's been a really interesting last few weeks. We've had major shifts in our day-to-day habits, our work habits, and even our social habits, and all this in a really short period of time. As a society, it's really unbelievable how we've been able to adapt to this. It's nothing less than phenomenal. As I record this from my home and my new temporary office, I wanted to share with you some of the questions that we've received over the last few weeks from our clients regarding the markets and the financial landscape. Our first video is going to focus on how is this crisis different from the last two that occurred in 2000 and 2008. It's different in three ways. The first one has to do with bubbles and excesses in the system. In 2008, we're dealing with a housing bubble. There was structural issues in the economy, a lot of irresponsible behavior by the banks and lending institutions, as well as consumers. Banks were undercapitalized, and there was a lot of over-leveraging. People were living way beyond their means. The housing bubble popped and impacted the entire food chain that was profiting from the unsustainable housing prices. In 2000, we had a tech bubble. Forget about profits, even non-revenue companies were trading at nosebleed valuations. And in 2000, everybody was a day trader. If you recall, even unprofitable, overvalued companies like Nortel represented 30% of the Canadian stock market. Today, yes, valuations are stretched, but by no means were they in a bubble territory. And that's to be expected after a 11-year bull run. And if you take into account the low interest rate environment, they were somewhat justified. We did have a few micro bubbles, like in marijuana stocks and in Bitcoin, but as a percentage of all asset classes, they were almost insignificant. We are dealing with an event-driven, self-imposed recession, which is very different, has very different characteristics. However, the level of uncertainty really does extend beyond just financial and health, as well as well-being. It's causing an extreme amount of volatility and sometimes panic, like we see in the daily market moves of March, how we have empty shelves in stores, and also things like toilet paper being sold out. The main issue that we're facing now are that some businesses aren't experiencing a 30% slowdown in sales like in past recessions, but some are actually experiencing zero sales, which is obviously not sustainable for a very long period of time and creates even more uncertainty. The second point of differentiation is balance sheets. In 2008 and 2000, the economy was already struggling and slowing down. In 2008, people were getting their loans called in and had to declare bankruptcy. There's no way for them to get financing, and the economic system was coming to a halt. Today, we came into this with much stronger balance sheets. We were not over leveraged, and our banks are really well capitalized, more than they've ever been before. We're a lot richer today than in 2008. The unfortunate news is that there's a lot of strain on workers and unemployment is really high. However, this is different than the other types of recessions. Companies want to hire people, people want to work, they just can't right now. Of course, if this continues for the long term, it's going to cause a major strain on the overall economy, on individuals and corporate balance sheets. The third point of differentiation is the speed and swiftness of the government policy. It's been really impressive. In 2008, the central banks waited 7 months before starting to get involved with interest rate cuts. There's also the moral hazard of holding stimulus back. There's a moral hazard of, well, why would we help companies like automobile companies and banks that got us into the mess in the first place? We don't have that same constraint today. Right now, we have a massive coordinated effort from all of the central banks to act almost with no handcuffs, since it was not one industry's fault or one company's fault. It's just a matter of circumstance. One of the positive things that came out of 2008 is that the government developed a playbook to deal with emergency type crises affecting the financial system. So we've been able to roll out programs at a much faster pace than in 2008. They didn't need to reinvent the wheel. They just needed to tweak and adjust and redeploy some of the things that were already put into place. We've also seen collaboration with governments around the world. For example, Europe, who's been traditionally more conservative, we're now getting a heavy dose of one, monetary policy, which means cutting the interest rates, 2, fiscal policy, which is the government lending and support programs, and 3, helicopter money, which is actually writing checks and giving cash to people and companies. The magnitude of the stimulus does seem like it's in line with the severity of the crisis for now. Overall, these differences lead us to be constructive or more constructive about an eventual and faster recovery from the crisis than we were in 2008 and 2000, as long as it could be contained in a reasonable period of time. Don't forget that the markets will adjust and recover a lot faster than the economy does. This crisis has brought about a lot of different shifts in our day-to-day lives. And it's been challenging for everybody to different degrees. But it's also shown us the incredible ability of resilience and adaptability that we're capable of. This might be the first time that the whole world has agreed to put human lives in front of economic concerns, and those who are suffering can find some comfort in the enormous solidarity we've been witnessing. On behalf of our entire team at the TWM Group, thank you for listening, and feel free to reach out to us.